Good morning. I'm Brian Curtis.
And I'm Doug Krisner. Here are the stories we're following today.
Well, the U.S. intelligence community and the White House are making an urgent plea for a concerted effort to fight China cybercrime. Ed Baxter has the story and more from San Francisco. Ed.
Yeah, that's exactly right, Brian. FBI Director Christopher Wray issuing a warning before a House Select Committee on China today, saying national state cybercrime is the defining threat of our generation.
If you took every single one of the FBI's cyber agents and intelligence analysts and focused them exclusively on the China threat, China's hackers would still outnumber FBI cyber personnel by at least 50 to 1.
Now, Ray says more funding, more support, more understanding of how deep the threat is. He says it is going to not only harm government, but business and the economy. He says more people needed. Meanwhile, the Justice Department has charged 4 Chinese nationals with smuggling American electronics to supply Iranian weapons production. The U.S. is now saying it will carry out targeted attacks against Iranian proxies covering several days. NSC spokesman John Kirby.
We believe that the attack in Jordan was planned, resourced, and facilitated by an umbrella group called the Islamic Resistance in Iraq, which contains multiple groups, including Kataib Hezbollah.
And Iran is hardening its position, saying it will hit back at any U.S. strike. Bloomberg Middle East editor Patrick Sykes says Tehran is talking tougher.
Then we had Biden overnight saying that they've made a decision on how to respond. And since then, in Iran, there's been a change of tone, promising a decisive response to any attacks on its territory, interests, or citizens abroad.
Now, the White House is intimating the next few days for its attacks. Heads of the country's social media companies in front of Senate Judiciary Committee today. Meta CEO Mark Zuckerberg getting a tongue lashing from Senator Marsha Blackburn.
It appears that you're trying to be the premier sex trafficking
Of course
site
not, Senator.
in this country.
Senator, that's ridiculous.
No,
Senator,
it is not ridiculous. You want to turn around and tell these people
content
that,
on our platforms. And
why don't you take it down?
We do take it down.
We are here discussing.
We do
we
more
need
work to
you
take it
all
down
to
than-
work
than-
with
than-
us.
than-
No, you're not. You are not.
Zuckerberg did offer an unscripted apology to the families of victims of sexual exploitation on the platform, saying, "I am sorry for everything you have gone through." Meanwhile, TikTok will pledge $2 billion this year on protecting children and other viewers on its service. House Speaker Mike Johnson has given its first floor speech on the crisis at the U.S. border with Mexico. This comes as a first article of impeachment against DHS Secretary Alejandro Mayorkas has been drawn up.
He's handicapping law enforcement. He's limiting their ability to catch narcotics like fentanyl.
He says the House will move swiftly through the process. We'll have a tough time in the Senate getting a conviction, though. President Biden continues to trail former President Donald Trump in each of 7 swing states in the latest Bloomberg News Morning Consult poll. The survey shows Biden is lagging Trump 42 to 48% across those states in a head-to-head matchup. And also, very interestingly, it showed that if Trump is convicted of any of the crimes, 91, against him now, half of the swing state voters, 53%, say they would not vote for him. 55% said they would not if he goes to prison. Global news 24 hours a day and whenever you want it with Bloomberg News Now. In San Francisco, I'm Ed Baxter. This is Bloomberg. All right, Brian.
Ed, thanks very much. The time 6.5 minutes past the hour. Brian Curtis and Doug Krisner. We wanted to drill down a little bit more for you here on the Federal Reserve and what happened today, and also get the market response. In a few moments, we'll be speaking with Ira Jersey of Bloomberg. But let's see what they did. Fed policymakers, they once again held the benchmark U.S. interest rate steady. Now, the Fed has been on hold since June, and it signaled openness to cutting rates, although just not right away. Powell himself, the chair, was reluctant to give a time frame for a potential rate cut.
We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question.
That's Fed Chair Jerome Powell. The decision to leave rates unchanged was unanimous, and the FOMC will hold its next policy meeting March 19th and 20th.
The other big story today in New York was the story surrounding New York Community Bank Corp. The stock was down over 37% today. NYCB reported a surprising loss for the fourth quarter. This is a regional lender. NYCB also reduced its dividend to 5 cents. Here's the thing. The street was looking for kind of a maintaining of the dividend at around 17 cents. So that was also a bit of a shock. Bloomberg Intelligence senior bank analyst Herman Chen tells us this was kind of a surprise, although NYCB is an outlier.
Pretty much across the board of their larger peers, everybody was actually pretty sanguine about 2024 credit quality. So this seems more of a New York community specific issue of needing to shore up their balance sheet and facing a blip on their credit quality that they need to instill some more confidence in the market.
That is Bloomberg's Herman Chen. Now, last year, NYCB purchased deposits from the now defunct Signature Bank. That happened right after Signature collapsed. Now NYCB is stockpiling cash. And one of the things that was also surprising today, we learned that provision for loan losses surged to $552 million. Needless to say, that came as a bit of a shock to both analysts and shareholders. Brian?
Well, Qualcomm gave a revenue forecast for the current quarter that was in line with analyst estimates. The company is projecting between $8.9 and $9.7 billion in sales for the fiscal second quarter. We get some reaction here from John Vinn, analyst at KeyBanc Capital Markets.
There's a little bit of consternation in the supply chain about Apple demand. I think we've seen sell-through get a little bit weaker in the China market. We've seen it get a little bit weaker in the North American market. But we haven't seen major cuts out of the supply chain at Apple, more broadly speaking.
John Vinn. Qualcomm is looking to decrease its dependence on the phone market with ventures into automotive and PC chips. But Qualcomm's earnings are still heavily influenced by smartphone demand, particularly in China. Shares of Qualcomm in late trading traded down about 0.25%. Well, let's get to our guest now, and that is Bloomberg Intelligence Chief Interest Rate Strategist Ira Jersey. Ira, sometimes the market reaction is more interesting than the event itself. And we saw a lot of selling today after Jerome Powell's news conference. It's funny because yesterday we were reporting that there was only a 1 in 4 chance now that we would see a rate cut in March. And so him more or less taking it off the table doesn't seem like it's such a huge surprise. Is this a hedge in the marketplace against maybe the Fed just being too slow and that would hurt the economy?
Well, we have to be careful about the timing of when we saw a lot of the market moves today, particularly in the rates market. Certainly, equities didn't like the idea that maybe the Federal Reserve was going to go a little bit slower than some equity investors had thought. But in the bond market, when you look at what happened in 10-year bonds and in particular 2-year notes, so that's the very front end of the curve, usually more sensitive to interest rates set by the Federal Reserve, those first started to rally, so prices went up and yields went down, and that really started after the employment cost index numbers came in a little bit better than anticipated. And then they actually did very little during the Fed. They actually went up and down, up and down, up and down, but they basically finished the end of the press conference right around where they were at 2 o'clock when the statement came out. But then at the very end of the day, you had month-end rebalancing, and what you saw, I think, then was stocks did really well this month. Bonds kind of didn't do very much at all, and you had people selling stocks to buy bonds, and you really saw that pretty massively right around the 4 o'clock close.
There's so much that I want to talk about, but one of the things that I want to throw into the pile here is the details on the quarterly refunding. Could that have had any impact at all in terms of the dynamic that you're describing across the curve?
If anything, I think it would have went the other way. So that move was a little bit surprising. So it's hard to disentangle these because the quarterly refunding announcement, so the Treasury Department said it was going to issue at least a bit more of 2-year notes and 5-year notes than we thought they were going to issue. So they're going to issue $9 billion more this quarter of both 2-year notes and 5-year notes, and they increased everything else because deficits are still running very hot. So you would have thought that with that announcement that the bond market would have sold off. So again, higher yields, lower prices. You didn't see that. You saw just the opposite, because that data, that announcement came out right at the same time as the ECI data, and I think the market really focused more on that employment cost index. That inflation data is much more important to the market right now than is the supply data.
The chair didn't really want to use the phrase soft landing, but when he was asked about it, his picture of the economy is reasonably good. I'd say it's very sanguine. He said, more importantly, that the Fed is not looking for growth to slow or for jobs to be lost. That's not what they're targeting. That's not what they want. They're simply looking at inflation coming down, and they're watching wages. And if you think about it, given the choice, isn't that what investors would want?
Yeah, they want the soft landing. So I think, Jay Powell was much more direct today than he has been as to the path of rates, right? Saying that his base case is not that they're going to cut in March. That's pretty unusual for any Fed chair to say, and certainly Jay Powell hasn't been as explicit as that in recent months. But at the same time, they are concerned that as inflation comes down, they don't want to leave the target rate, the Fed funds rate, too high for too long, because they're afraid that might drive those other good things, right? The corporate profits, the employment, and everything else might drive those down and cause a recession. So it's this weird balancing act that they're trying to do, and he might have sounded a little bit confusing about that, because they're trying to calibrate the market to the economy to their policy, and it's been difficult for them to do that, and that's often the case right around turn. So we think that they're going to start cutting in May, and then they might not cut every meeting after that, but they're going to cut at least a little bit.
One of the things that was not in the Fed's statement today that had been in the previous statement was the fact that the U.S. banking system is sound and resilient. It may be a little ironic that this occurred on a day when we're talking about New York Community Bancorp and a real buildup in loan loss provisions, all the way up to $552 million. A lot of this is tied to office space, commercial real estate. Is this a canary in the coal mine? Should we be concerned about this as it applies to maybe a few other regional banks, or is this an isolated case on the part of New York Community Bancorp, do you think?
Well, I would defer to my colleagues who cover the banking sector, but my thought has been since last March when we had the banking hiccup with SVB and Signature is that in a way I feel like a lot of what's going on right now in the regional banks and the smaller banks is more similar to the savings and loan crisis that we had in the late 80s and early 90s. And so there will be issues that will crop up here and there for any variety of reasons. You'll notice that when you have New York Community Bancorp, not a small bank, but at the same time, not one of the globally systemic financial institutions, which have so much equity capital right now, and they have to hold so much and not take nearly as much risk as they, were allowed to prior to the global financial crisis in 2007 to 2009. So I do think that these issues will in regional banks will crop up now and again, and it's might be a fact of life, and so I can't say if it's certainly not systemic, right? Mm-hmm. Not in the way that Citigroup was or Bear Stearns was back a decade ago, but it does matter, right? And it is something that's going to certainly affect market psychology, if nothing else.
I also found it interesting that Jerome Powell was not that concerned about inflation turning higher. He said he was much more concerned that inflation would stabilize at too high a levels. In your own analysis, do you see that as a quite reasonable possibility?
Yeah, I don't. When we look at the data, what we see, and Jay Powell alluded to this today as well, is that goods prices have been coming down, but the services sector, even services excluding housing, are still running at a reasonably high pace, and are going to keep inflation a bit higher than maybe some would like to see, and certainly it's going to make it hard for inflation to come down to 2%. If we go back even to the mid 2010s, and you go back to 2014, 15, 16, it turns out services inflation was running at 3%, but goods prices were falling. So that's how you wound up with the PCE deflator with a two handle. So whether or not that can be maintained, I think will be very important to the Fed's read on monetary policy and what it's going to do going forward. Either way, I do think that the Fed is going to cut, right? I think the big question that the market is going to continue to have to ask itself and probably reprice for, because I think it's mispriced right now in terms of how fast it's going to cut, is firstly, is the pace of those cuts, and then secondly, are they going to actually cut to 3.25% like they suggest that they will in 2025, or will they have to cut more or less based on the path of the economy?
This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street.
Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast.
You can also listen live each day on Bloomberg 1130 in New York, Bloomberg 99.1 in Washington, Bloomberg 106.1 in Boston, and Bloomberg 960 in San Francisco.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130.
Plus, listen coast to coast on the Bloomberg Business app, SiriusXM, the iHeartRadio app, and on Bloomberg.com. I'm Brian Curtis.
And I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.